NVIDIA Corporation, the stock with a market cap of 396 billion, a PE of 52, and a dividend yield of just 0.1%, just reported Q3 numbers, and the market wasn't really moved by what they saw as the stock is just up about 1% after hours. The business missed on earnings and had a decline of 16% year over year in revenues. So, seeing as this is essentially America's largest semiconductor, at least by market cap, what do we make of the business after this earnings release? And should we as value investors be buying into this stock now that the stock actually is down about 47% year to date? Well, we'll be answering all those questions and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Again, we will be starting with the full analysis into the financials. We'll go through the top line, bottom line, balance sheet. We'll also talk about some of the things going for this business. We were just notified today that NVIDIA and Microsoft just partnered up to build a massive cloud AI computer. So again, we'll talk about the future of this business in just a little bit. Finally, we'll conclude with an evaluation of this business using our intrinsic value calculator. And if you enjoy this type of content, make sure to subscribe because we post on here regularly, analyzing the businesses you're most interested in. So if you do have video recommendations, leave them in the comment box below. With all that being said, let's jump into the analysis. So we'll start with a business overview for NVIDIA. What makes up this business? Well, it's primarily marketed off into 4 different segments. We have gaming, we have data center, we have professional visualization, and we have automotive, okay? The last 2 here are definitely something this business is working on growing. They only make up about 10% of revenues. The majority of it comes from gaming and data center. And so let's talk a little bit about their market, okay? They're saying they have a $1 trillion opportunity ahead of them, especially as the world progresses with more computer reliance. We're gonna need chips to power those things, and that's why there's more opportunity, especially coming from that automotive segment where cars need to actually perform at a higher rate now. They need to do more things, be able to park themselves, drive themselves, etc. So they're saying there's a $300 billion opportunity for that, $100 billion opportunity for gaming. Same thing with chips and systems. There's another $300 billion opportunity there, and then we combine NVIDIA AI and Omniverse, another 300 billion there. All together makes up about $1 trillion worth. And we can see here how almost everything needs chips in today's day and age. Over 3 billion gamers now, over 45 million designers and creators, 20 million servers per year, 100 million vehicles per year going forward. So you can really see how this business is going to be able to benefit, and they have massive tailwinds there in the long term at least. Let's talk about their segments. We'll start with gaming. We can see at least over the last few years, massive growth here, especially into 2022, fiscal year 2022. Obviously, we did have a lot of lockdowns. People were staying at home and gaming a lot. So this number is probably going to be much higher than what they're going to be able to produce for fiscal year 2023. As we can see though, at least the immediate future, the first half of this year has actually produced about the same revenues as last year, but you can see they did have a strong second half of the year. I don't know if we're going to see that same thing here. We are approaching the holiday season. People might be spending more on gaming, but we can see here, this is the world's largest gaming platform. They're the leader in PC gaming with over 80% market share, with 200 million plus gamers on their GeForce product, and future growth drivers as well. We can see why this business has been growing the way it has at 25% year over year, right? If we look at how this has progressed over the last few years, more and more people are gaming. We can see that as the generations go on. We can see how this has progressed again from 2017 to 2021, now up to 3.1 billion gamers. They're releasing new products, as you can see here, with absolutely insane processing power. So again, a lot of good things going for them in their gaming segment. When it comes to this quarter though, what they mentioned is that revenues are actually down 51% from a year ago and down 23% from the previous quarter, despite launching their new GeForce RTX product. They didn't really mention too much on why this business was impacted, the gaming segment that is, but obviously we do know, like I mentioned earlier, they had a lot of lockdowns. People were more interested in playing video games as they were locked up. They couldn't go out. So we are seeing a bit of a slowdown here. Then that leads us to the data center segment, the leading computing platform for AI, HPC, and graphics. Again, this is another product that is used by all hyperscale and major cloud computing providers. Over 35,000 organizations. We can see they have growth drivers as well. And ultimately, that's why we can see they have a 66% 5-year CAGR. We look at it from this quarter's perspective. We can see their revenues are actually up 31% from a year ago, relatively flat from last quarter. Again, massive market share, powers 90% of the new systems in the latest top 500 list of the world's fastest supercomputers. They announced multi-year collaborations with Microsoft and Oracle to speed up this business as well, along with Nuance Communications. revenues. So despite a slowdown in gaming, data center is up 31%. That leads us to the next segment here, professional visualization. Another area in where they're the leader in workstation graphics, 90% of the market share. I mean, we can really see why this business does host the largest market cap for the semiconductors, at least in America. Again, so far doing well this year. But when we look at this from this quarter's perspective, we're actually down 65% from a year ago and down another 60% from the previous quarter. Again, we have to take into consideration these results that they're posting are definitely off the backs of an economic slowdown here in comparison to last year. There's definitely been some tightening of consumer spending, and so obviously a semiconductor like NVIDIA is going to take a hit here, especially in their gaming segments, especially in their professional visualization segment. And finally, that leads us to automotive, one of their newer segments with autonomous vehicles and AI cockpits, another segment in which they're the leader in autonomous driving. They have over an $11 billion win pipeline through fiscal year 2028. Again, we can see their growth drivers. They do have partnerships with Mercedes-Benz and Jaguar Land Rover, which will start production in 2025 and 2026 respectively. So we can expect these revenues here to start to grow further. When it comes to this quarter, at least, they're actually up 86% from last year's revenues. And with the pipeline in place, yeah, this segment of their business should definitely improve in the future as well. Now let's talk a little bit about their competitors, okay? So on the screen here, we have Intel as their competitor, Taiwan Semiconductors, Qualcomm, and AMD. And we can see if we do a like-by-like comparison over last year's revenues, we can see NVIDIA in orange here is producing about $30 billion year over year in revenues, which is actually towards the lower end of the broader sector, with Intel and TSM up near $70 billion in revenues. Now, if we look at this from a margin perspective, they have about 35% margins, which is in and around the middle of the pack here, but you can clearly see the difference that TSM has over the rest of the competitors here, a big advantage when they can produce their products for much cheaper. And then if we look at this from a net income perspective, NVIDIA is able to produce about $7 billion in net income, again, towards the middle or lower end of the broader sector here. Again, great growth here from TSM. We've seen the recent decline in Intel's business, but I'm just showing this to you to give you a bit of context on where their competitors lie right now. If we look at this from a price to earnings ratio, NVIDIA does have a relatively high PE along with AMD, meaning these two stocks are pretty expensive here compared to the rest of the broader sector. So keep that in mind if you are looking at this for a potential investment. Finally, we'll look at this from a market cap perspective. Again, $400 billion market cap. The only other stock that's up in and around that range is TSM, and we can see they're actually probably the best fitted semiconductor there is right now, but there is that geopolitical risk with that stock there. We don't know what's going to happen with China and Taiwan. But again, these are just things to keep in mind if you're making an investment decision on this stock. With all that being said, let's take a look at their Q3 fiscal 2023 summary. Revenues of $5.9 billion. Again, last quarter, $6.7 billion, and last year, $7 billion. So we're down 12% quarter over quarter, down 17% year over year. Gross margins are also down 11 points, now to 53.6%. Operating expenses are up 31% year over year. And so that leaves us with operating income here of $601 million for this quarter. Again, down 77%, huge decline here on operating income. And then that will hold true for net income and earnings per share. Finally, if we look at this from a balance sheet perspective, about $13 billion in cash. When we look at this from a debt perspective, they have about, let's just call it $11 billion in debt. So liquidity is not an issue here for this business, at least. The issue is definitely with their expenses increasing by the substantial rate that they have. All right, and so if we take a historical look at this business, they've been able to grow their operating income over the last few years, but with the slowdown in the recent quarters and with the deterioration of the margins, at least for this year, I'm going to estimate that this business can only do about $5 billion in operating income going forward, at least until we see a nice rebound in the fundamentals and in the economy. And so if we plug that into our calculator here and we require a 10% return, they do pay a very small dividend. And if we expect that this business can grow for the next 5 years at about 5%, that jumps up to about 8% on the backs of a rebound in the economy over the next few years. And they are trading at a 52 PE currently. Let's just say that sits at around 40 on an average scenario. Yeah, the stock should be worth only about $75 per share, meaning we're a little bit overvalued here for this business on a very normal scenario. Now, again, we have to also understand I am using very small numbers here. If we look at their 5-year EPS and revenue growth estimates, they have been growing at around 31 to 43% on a year-over-year basis. So if we did bump those numbers up to like 15% and 18%, yeah, we can see that this business is probably worth more around that $160 price range on an average basis. Now, in the very best case scenario here, let's say they can actually stick to in and around those 5-year revenue growth estimates of around 25%. That drops down to 18%. On a 45 PE, the stock should be worth about $265 per share. Right now, we're sitting at about $150, $160 per share. So a nice bit of stock appreciation on the backs of a rebound in the economy where people are spending more and their automotive business starts to take off, professional visualization, etc. Yeah, we could probably definitely see this business up to 265. Again, if we were just talking about just last January, we were up to $300 per share. So yeah, definitely possible for this business. Finally, in the very worst case scenario, let's say this business can only grow at like 2% for the next 5 years. Then it slows down and doesn't grow at all for the next 5 to 10 years after that. On a 30 PE, the stock would be worth only $41 per share. Again, it's the cardinal sin with all growth stocks. As soon as the growth stops, yeah, we see a massive decline in the stock. Not very likely for NVIDIA with the vast market share that they do have across all their segments. There is a reason why this business does have such a high market cap in comparison to the rest of the sector. They do have massive market share across the board, and always take that into consideration when you're going to make an investment, because yes, while you may be paying upfront for this growth and for the underlying business, if they can actually deliver on this going forward into the future and things like automotive really take off and their gaming segment actually pops off and we see continued progress with their data center, etc., yeah, this business might definitely be back up into those 300s again. But we do have to understand that right now the economy is not in the best of places. And so it's important for us value investors to understand that consumer spending is tightened up a little bit right now. And once interest rates finally start to decline a little bit, people are definitely going to be spending more. And businesses like NVIDIA are definitely going to benefit from that. So again, keep that in mind when you're making your investment decisions. That's my analysis for today's video. If you've enjoyed it to this point, make sure to leave a like and subscribe. It really helps out the channel. Always comment your thoughts as well, so we can get a little bit of a discussion going in the comment section below. But with all that being said, thanks for watching, and I'll catch you on the next one.